Today we're going to be talking a little bit about cash flow and profit, but I'll give you guys a little bit of introduction about who I am and how I fit in. My name is Tawanda. I run a bookkeeping and payroll organization called Trendsight, and effectively we manage everything from day-to-day finances to payroll, reporting, budgeting, for childcare organisations and a bunch of other organisations as well. Like I said, today we're here to talk about where did the money go. I'm sure this will be a familiar story for all of you, getting a report from your bookkeeper, or maybe you putting it together yourself, which shows your profit. You see a healthy profit at the end of the month, but you look at your bank account balance and things don't look quite right. You don't have the money which you thought you made. Is that something that everyone can relate to? Or, yep, great, I can see a few nods. So that's what we're here to talk about today. We're going to talk about what is actually happening there. Why are you seeing profit in your business, but no cash in the bank? And that's the whole game. So 2 quick points about what is profit and what is cash. They can be pretty simple concepts to sort of think about initially, but as you can probably all attest to, they're not always so straightforward. So profit is really just a scorecard. It's showing you exactly how you've performed over a period of time, so whether that's a week, a day, a month, a year. Whereas cash is really, that's the lifeblood of your business. From my perspective, that is the more important number, and it is really what's sitting in your bank account. So in a childcare setting, there's a few things that are going to impact what is actually going to impact your cash flow, and I put them into 3 main buckets. So timing is going to be a big problem you guys are going to have. So whether it's the fact that CCS comes in, a week after enrollments and attendances, or whether it's the fact that you may actually be paying payroll today and that CCS is coming next week, all those timing problems create cash flow issues for you. Big and lumpy expenses as well can be quite a big problem. So think about things like investments into a new playground, or maybe a big repair you're going to make. Things like that don't always necessarily sit on your profit and loss statement. And that's why sometimes you can see, profits look great, but cash looks bad. And then as well as that, if you run, say, an OSH or a similar service where you've got a lot of seasonal adjustments that happen, or maybe holidays you're closed, that's always going to have a really big impact on what your cash flow looks like. So we're going to go through what these things are and how we can essentially manage for them and make sure that you guys are having both healthy profits and healthy cash flow. So if profit doesn't tell the full story, what does? And we're going to talk about 4 main concepts today that are going to communicate what actually is the full story when it comes to profit. You won't hear me use the word balance sheet a lot in this session, but the elements that I'm going to talk about, that's where they live. And these are the 4 elements. So at the moment, if you're looking at your profit and loss statement, you're really only focusing on one of those 4 elements. That's the profit. We've got 3 other elements that are worth discussing as well. So the first one is working capital. I'll go through what each of these means. Other capital, and the last one is funding. Now those first 3 elements are going to determine what you need here, and I'll explain that in just a moment. So let's go through these one by one. So what is profit? Profit is purely just your income minus your expenses. So think about it as your CCS plus your parent fees minus your wages, your staff costs. That is your profit. But like I said, it doesn't tell the full story. Working capital is the timing. I've talked about timing already. So working capital is your timing differences. So you're looking at things like, are your parents paying late? Is your CCS delayed for whatever reason? Is it a month where you're going to pay your BAS or your PAYG withholdings? So all those elements, they're all about timing. You may process your wages today, but your super only gets paid next month. So that timing impact is going to impact, what you actually see in the bank versus what you see on your profit and loss statement. So sometimes your profit looks great, but your cash is trapped because of these timing differences. The third item there is your other capital. So this is all your investments that you're going to be making in your organization. So that's, playground, upgrades, new security systems, any sort of capital investment, any improvement you're doing to your service. That is what I'm referring to when I talk about other capital. And these are items that don't sit on your profit and loss statement. And the last one is funding. So when we look at those first three elements, your profit plus your timing differences plus your capital investments, that's going to leave either a shortfall or extra money you have left over. If it leaves a shortfall, that now needs to be funded. So whether that's through a loan or an overdraft or personal funds. And who here has had to dip into personal savings to, I can see a few hands going up, to essentially bridge those gaps. So that's what's happening there. You've got your profit, you've got a minus all your bits and pieces, and you're left with a hole. So if we look at this as an example, you might have a really great month and you made $120,000. You get your profit and loss statement from your bookkeeper and you're like, great, I made 120 grand. Things look really, really good. But then you look at, well, what else happened? Maybe your parent debt grew by, and that's a really large number, but let's just say 40 grand, right? So let's say you're not using direct debit as a service for whatever reason, and your parents are doing really, really bad paying their bills, and therefore you've now got an increase in debt. So that's now money that you should have banked, but hasn't come in. You've also then spent 90 grand upgrading playgrounds, you paid a BAS, you paid your PAYG withholdings for the month. So if we look at all of that, we end up now with 120 grand in profit, but 130 grand of cash outflows. So what's actually left there is you needed to put in an extra $10,000 into the service to keep things going. And this is sort of the reason why sometimes it can look like your profit's really, really strong and really, really good, but you've got these other elements that are really hitting you hard. So how do we fix it? We're going to talk about each of these elements and some key tools we can use. But quick question, which of these has been sort of the biggest impact to you guys? So if you don't have to do a complete overhaul, but if profit has been a problem, any hands for profit that's been a problem? Great. What about working capital? So, timing differences, having to suddenly pay for a bath that you forgot about or didn't know. Other capital, anyone doing any investments in playgrounds or repairs, things like that? Yeah, I see a few nods. And we've already talked about funding and people having to put money in. So how can we fix this? That's what we're going to focus on for the next little bit. So I've put together 6 levers that, this applies to really any business, and I've tailored these specifically to this audience. So these are levers that, firstly, I want you guys to focus on not as only owners, but also as center directors and center managers. Both of those roles has control over all of these elements. So if you're in here as a owner operator, don't feel like this is only your burden to sort of hold, but center directors, this is somewhere where you can also have a really, really big impact. So the first one's fees, which is really price, occupancy, which is volume, and then you've got direct costs like food and staff wages and things like that, overheads, accounts receivable, and accounts payable. So these are the 6 levers, and we're going to talk about how you can play around with these to not only increase your profits, but also improve your cash flow. So if we look at fees as the first point, something as simple as a 1 or 2% increase, especially when communicated really, really well, is going to have a massive impact on your profitability and cash flow. The great thing about fees is they can be challenging to increase, but when done really, really well, it's an immediate hit to your bottom line. Like there's no additional cost that comes with increasing fees. There is obviously other elements that come with increasing fees, managing parents. If you've applied for the worker retention payment, you're obviously limited to what you can do with that. But an increase in fees can have a really, really significant impact to your profit and your cash flow. So as an example here, just $2 extra a day for a service with 80 children can be as much as $35,000 of extra profit. And if you're collecting all of that, that's also extra cash flow that comes through. The second one is occupancy. So again, this is a little bit more challenging because again, depending on what your rooms are set up like, depending on how you do it, but increasing occupancy just by 1 or 2 spots can have a really meaningful impact to what you're actually doing. So if you're a service with lower occupancy and you do have room to increase occupancy without having to necessarily put on more staff or ratio, that can be a really, really good way to also improve the bottom line and also cash flow. Direct costs are a big one as well. So managing staffing, making sure your rostering is really solid. Something we see quite a lot with the services we look after is rostering, which is done way too last minute. So making sure that you're rostering at least minimum 2 weeks out means that staff are prepared, they know their shifts are coming up. You're less likely going to have people pulling out of shifts and you're having to bring in casuals and all sorts of things. So rostering really, really well is going to be really, really important to make sure that your direct costs are managed really well. But also negotiating suppliers. Who here has actually spent a bit of time trying to figure out, can we get a better deal on food? Does anyone spend any time doing that kind of stuff? Sick. Not really?
It's been probably 2 years.
Yeah. It's really worth doing it. And even doing things like, using less suppliers, not more. So if you're using a lot of different, suppliers for food or for materials or, resources and things like that, try to consolidate all of that. If you're buying more from one supplier, you're likely to get better pricing as well. So negotiate, see what you can do. Particularly for things like repairs or even gardening and maintenance. So have a look at, at least once a year, spend the time seeing what can you do to get a better deal. Overheads is a big one as well. So if you're not running, not-for-profit, or if you don't have rent to pay, then this doesn't really apply to you. But if, in most cases, people are paying leasing costs, you're paying for a lease, you're paying for the building you're operating in. A lot of the time, negotiating or renegotiating leases is an option which most people don't think about. So have a chat with lawyers and see if that's possible, particularly where you've found that your service maybe isn't performing as well as it once did and your revenues are down. There could be room to actually do that. So don't just put up with the fact that, hey, I'm paying a really high rent and it's actually making me lose money. Most landlords are going to be in a position where they would rather keep the tenant in than lose them if you can renegotiate something. So just think about these little bits and pieces and what you can actually do to help lower your cost base, but also improve profitability. The last two are accounts receivable and accounts payable. Now, is anyone here still doing, is anyone here not on direct debit with their families? Great. Awesome. Okay, so everyone's on direct debit, which is fantastic, and you should be, because if you're not, that's a really, really big opportunity to move everyone to direct debit. If you are on direct debit, which it looks like everyone is, think about things like how far in advance you actually invoice. Is it a few days? Is it a week? Can it be 2 weeks? The way I think about accounts receivable and accounts payable is you want to receive all the money as quickly as possible and pay your suppliers as late as possible. So if you can get as much money as possible upfront, but pay your suppliers with better terms, which we'll talk about in the next slide, then you're going to have more cash in the bank more often than not. So think about how you follow up as well. Even people who, if direct deposits are failing, How quickly do we follow that up? What does your accounts receivable actually look like? If payments are failing, what processes do we have in place to ensure that we're chasing that up? And then in hand with that is accounts payable, and that's what I just mentioned before. So can you extend payment terms? Can you, if you're using Coles and Woolworths are a great example, both of them have got really, really beneficial terms. Are you paying up front? And I know a lot of services do this. They'll just, get a personal Woolworths or Coles account and you just pay by credit card every time you pay. You don't have to do that. It's really easy to get an account with either of those organizations, and all of them have got up to 45-day terms. If you ordered a Coles, food delivery today, it doesn't have to be paid until the 15th of the following month. So if you're doing a purchase on the 1st of September, you don't have to pay it until the 15th of October. So think about things like that, like where else can you be setting up accounts and not paying cash up front? All of that's going to impact how much money you have sitting in the bank. Like I said, the big problem here is not necessarily that you're not making money, it's that you receive CCS a week late. You might have parents who are paying late. So whatever you can do on the cost side to make sure that you're paying expenses as late as possible is going to help bridge that gap a little bit.
Yeah, because we can't even advance bill on direct debit because we have to wait for CCS to come in. So then the parents are direct debit their remaining gap. So even when you're saying about billing in advance, it's too much.
For an OSH service?
Yeah.
Yeah.
Imagine any parent paying upfront full fee and then having credit the next 2 weeks. You get billed after CCS and CCS doesn't process till after attendance. So I don't know how everyone does it. Most services are billing a week in arrears.
It doesn't actually direct debit if an account's in credit, so we're all here with owner.
Yeah. Well, look, I can have a chat with Kiang and get a bit more understanding about how that works as well on your ends. But I know, from my personal example, which is with our kids, we get invoiced 2 weeks in advance. So exactly. So yeah.
They told us not to do that.
No, they changed it. A couple of years ago.
No, owner told us. We only moved to owner last year.
Yeah,
So
same with us. And we were told that we couldn't. We've got 36 services, and we were told that we can't be in advance.
Yeah.
Okay.
And so when an account's in credit, it doesn't debit.
Is,
I don't know where that comes from. That shouldn't be the case. But so the recommendation from CCS is to do it in arrears, right?
Yeah.
And we say that too. But you still can do it in advance. It's up to you.
Yeah.
But would the parent have to pay the full fee up front? No.
It's still the gap.
William was a parent 2 weeks in advance.
No,
1 week.
1 week and a half.
1
Yeah.
week, 1 day.
Yeah.
Full month, but invoice.
So it looks like that's really sparked a lot of discussion, and I think it's it looks like there's a big opportunity there then in that case. So if you are doing it in arrears, that means you're definitely receiving everything in arrears, which is a massive hole, particularly when you got to pay your staff before you get any of that income, right? In my mind, I was thinking most people are billing in advance, but no. Okay, great. So big opportunity there already. So like I said, get as much income as possible early and pay as much as possible late. So this leaves us really with 3 action points, right, that we can do. So the first thing is profit, great to track, but also track your cash flow. So if your bookkeeper is only showing you, how you performed on a profit and loss basis, ask them the question, hey, can you show us what cash flow looks like? If you use tools like Xero or even MyOb, they're fantastic for giving you like a cash report, which you can actually see, how have I performed over the course of the month, not from a profit perspective, from a cash perspective. Focus on those 6 levers as well. So just prioritize, right? I think accounts receivable is quite a big one, but prioritize and see, well, what can I have the biggest impact on, and work through them one by one, and actually make decisions, do things that are going to impact your business. A lot of this is not about necessarily increasing the amount of revenue or decreasing the amount of costs, but managing when those things happen. And then the last one is plan for capital spending and cash impact. So it can be really, really easy to look in the bank account and be like, I've got a lot of money, and forget that, hey, actually, there's a BAS due next week on Monday. And then you go and you spend all this money on some upgrade, and then next week you're short of cash. So make sure you're planning for any big spend. Budgets are really, really important. Get one of those in place, and then that way you can know, hey, well, can I actually afford to do this upgrade I want to do? Can I actually afford to hire this extra person that I need to hire? And that's essentially it. So nice, short and sweet, but a couple of things to keep in mind of. If you do need help managing cash flow or even just purely with your reporting or how you look at things, get in touch with us, that first QR code. The second one, we are doing a little bit of a freebie. So if you are wanting to have a discussion, a broader discussion about what we've just talked about, for the first 10 people only, given that it's about an hour of my time on a call with you guys, I'll be happy to hop on a call and discuss that and see, hey, what can you actually prioritize? What's the first thing to look at when it comes to cash flow, and what are the opportunities that you guys can play with? Are there any questions or any other thoughts based on that? No?
I'm okay with all you presented, but I'm more interested to know how, say, look at the what's it called, so how profitable a business is, like call some the KPIs.
Yeah.
Would you be able to quickly just explain, say, like revenue, the revenue against the staff wages
Gotcha.
ratio.
Yeah.
And then revenue against the rental ratio.
Yeah.
And that's
So a lot of that really depends on the type of service, firstly. So it's going to be very different from an OSH to long daycare.
Yeah.
But what we find is for generally like long daycare services, revenue to wages, anywhere 50 to 55%, you're doing pretty well. If you find that, if you're below that, then fantastic. And the metric I'm talking about here is wages as a percentage of your revenue.
Does that include things like payroll tax, superannuation?
So I'm generally they're looking at just the broad wages and super. It's going to be a little bit more complicated now with the worker retention grant and things like that. So I'm leaving all that out because I'm assuming that the grant is covering all of that. So 50 to 55%, you're probably doing pretty well. If you can get below that, even better. And then leasing costs a hard one because it's going to depend where you are. So if you're inner suburbs, it's going to be a lot higher. If you're outer suburbs, if you're regional, it's going to be very, very small. So I don't have a...
Sorry. Do you normally check these KPIs in monthly basis or in quarterly basis or in year?
As often as you can is the answer I'd give. So minimum monthly.
Because monthly, I found I'm keep checking my KPIs. I found because the months we pay wages, and then say if the payment day.
If there's 3 payrolls in the month versus
so
2,
the beginning of the month and
yeah.
end of month, and then your number is
Yeah.
quite
Yeah.
saturated.
Yeah.
I don't know how you
You've got a couple of options with that. So, and the question there is, you'll have some months where you've got 3 pay runs versus 2.
Exactly.
The way we choose to deal with that is you've got 2 options. One, you can accrue it and you can, even out the wages across the year. That's too hard. So what we prefer to do is we budget in that same way. So we say, well, they're going to be 3 pay runs in that month. Then we budget in that same way. So it means that in that month, your revenue as a percentage of wages, wages percentage of wages is going to be higher, but we expect it to be higher. So that's okay. The way we do our budgeting, as long as we can explain that variance, or we can budget in the same way it's going to occur, then that's fine. We find that doing things like accruals complicates the accounts, and it means that most people who are running childcare services don't necessarily have a strong financial background, and just confuses things a little bit. So I'd rather say, hey, wages are higher this month because we had 3 pay runs, rather than saying, we've accrued or taken some wage cost out and put into the next month, and it gets a bit complicated.
Right.
Yeah. Cool. Any other questions or thoughts?
You said 50 to 55% is a good percentage wage to revenue. In your experience, for seeing a lot of centres, what's a good profit percentage?
Ooh, that's a good question. I don't know off the top of my head, to be honest. I don't know. I'll have to come back to you on that one. We do a lot of, because we look after a number of services, in our reporting that we provide, we can benchmark, and we effectively, across 4 main metrics, being your direct costs, your staff costs, your occupancy costs. By occupancy I'm talking about like leasing costs, like rentals. We'll benchmark all of our services across those areas and show you how you're performing against others. I don't have the number off the top of my head for profit, unfortunately. Sorry, I should have come better prepared for that one.
Just to confirm, when you said wages, you're just doing wages and super, you're not doing payroll, you're not doing
Payroll tax.
you're not doing workers' comp, things like that.
We track that as well, but the 50% I was talking about was just talking about wages and super. Yeah. But we do track both. When we do our benchmarking, we actually do labour costs as a whole. So we'll say everything associated with that. So labour costs is wages, super, payroll tax, work cover. If you're in, depending what state you're on, you might have portable long service leave. You could have staff training. So anything that is involved in you employing staff, we dump into labour costs, and then we compare that centre to centre. It's a little bit higher, so that percentage is closer to 60%. Yeah.
Is there, for the people that are hopeless at maths and want all the information given to you, how's the best way to work out what your percentage is currently?
So I don't know what it's like in MyOb, I know you use MyOb. But in Xero, there's a really cool, who uses Xero? Most people. So Xero's got if you run a P&L, you can click, there's a button which literally says percentage of revenue. And if you click on that, every single line, it will show you as a percentage of the revenue. Try and find that in MyOb. That's the easiest way. That's the easiest way to do it with the default reports that are in the system. Yeah.
Okay.
Yeah. So if you do that, it'll tell you everything. So it's pretty handy.
Yeah, maybe that's a request for owner. I don't know if you can consider to embed like a sensor performance KPI in the system for the owner to keep track how well the business is performing.
Yeah, so
Is that something you can consider that then don't you spend time to work out how much the total
that is the challenge. It's always about where the data lives as well, right? So it's like OWNA's fantastic, it's got all the revenue in it, but it won't necessarily have all your other costs in it. So it is a bit of a challenge.
Is that where potentially networking with like a company like yours with OWNA is going, where you can have a one-place platform that does everything?
I did discuss about the data came software. You know, that's the thing is, because we own that platform, we own the HR platform, we're able to collect all that data in one spot and be able to present that to everyone. That's the end goal, right?
Yeah.
Right.
Systems there in place so that we can present the data to you rather than having to tap onto multiple systems to pull through across all these different boards.
Yeah.
Sorry, in the rostering screen you've got the percentage of that. Does that include the super or is that just straight wages?
It's just wages.
That's just their hourly wage
And
percentage.
it does include super as well. There's a toggle to turn super on and off. It's just just the hourly rate.
Yep.
And then it's simple, so just the hourly rate plus the super on top.
Okay.
Yeah.
So it's relying on you putting in the hourly.
Yeah.
That's right. Yeah. It does include stuff like overtime and all that.
Yeah. Yeah.
Sorry, it does include the super.
Yeah, and you've got to be careful as well with that because, like Kiang just said, it doesn't include. So if you've rostered a person on all the other on-costs, like any education leaders allowances or things like that, they're not going to be in there, or overtime. So yeah, it gives you a rough idea. Yeah. I might finish it up at that. If anyone does have any other questions, I'm still going to be at the table there, so please come have a chat. Otherwise, thank you so much for joining us.